You've had a number of economic indicators recently that point to reasonable, albeit unexciting growth, while inflation has been a tad higher than expected. In short, there seems to be little scope for the Reserve Bank to cut interest rates further. Certainly a tricky setting for fixed income fund managers. Here to share his views on the chances of stagflation, for instance, is Conrad Wood from Momentum Asset Management. Welcome, Conrad.
Thanks, Rika.
So what are you doing? So, as I said, must be pretty tough.
Yeah, the environment has sort of become a lot more uncertain for fixed income investors. I mean, a month or two ago, we felt fairly confident of the potential for another rate cut, particularly on concerns around the global growth scenario. But the domestic fundamentals have arguably deteriorated to such an extent that we're now comfortable to sort of invest for flat rates for a meaningful period of time, rather than try and bet the farm on further monetary easing.
So within the suite of fixed income sort of assets that you can go for, then does it mean that a government type of instruments are less attractive and you'd rather go for corporate credit, which might offer better yields?
So I think the change in monetary policy outlook does make it a little bit more challenging to get yield in fixed income markets. As long as you've got the underpin of rate cuts behind things like bonds and inflation-linked bonds, their returns are always going to be, fairly attractive. Now, without the underpin of rate cuts, although I must say it's not a train smash, rates are still going to be low for long. But without the underpin of further cuts, the prospects for bonds to do well from here significantly do decline. So we then look to other things in the portfolio. Yield enhancement from credit investments do become appealing, and they do help to protect the portfolio and try and give you some sort of positive real yields in an environment of very low real yields at the moment.
Conrad, just in terms of the question around interest rates, and obviously we've seen the inflation was a little bit higher than expected. It's now getting to the top of the inflation band. We've also seen the rand getting sucked into this debate because of what's happened in the mining industry, which is responsible for a lot of our export earnings. Given the weaker rand now at about 8.70 to the dollar, is the effect of the rand going to play into inflation in the near term?
So the weaker rand is definitely a challenge for inflation, but our view is that it's perhaps less so than in previous cycles where the pass-through from a weaker rand was quite quick and quite direct, and you could see it come through into inflation pretty quickly. Now, with the economy as benign as it is, it's very difficult to pass through rand weakness to consumers, for example, if you're a corporate. So the weakness is there, and things like the rand oil price are at very elevated levels. But the impact on inflation should be a little bit less than what we're used to in cycles previously. So a little bit of a respite. I don't think inflation is that much of a problem at the moment that we need to start to be worried about monetary policy.
Just in terms of that inflation limit, though, the Reserve Bank's shown they have discretion in using their ability to let inflation temporarily go above the band that they've stipulated. What's your thinking in terms of the way inflation's moving at the moment? If it goes outside the band, do you think the Reserve Bank's going to act quite quickly?
So this is the new Reserve Bank. They're under a flexible inflation targeting mandate, to use their own words. And that essentially means that they will be a little bit more tolerant of inflation, as are most global policymakers, a little bit more tolerant of inflation while they focus on the benign growth environment. So they will try their best to do their part using monetary policy to try and get this economy going and to try and get some momentum behind the economy. The challenge for them is, well, what can monetary policy really do from these low levels? And if they feel that they're pushing on a string, they're unlikely to react. So we definitely, when we look at fixed income investments, we price in a Reserve Bank with a much more flexible mandate, more tolerant of inflation, with a focus on growth and employment creation, and thus it's quite feasible that we could see inflation out the top of the band without them being quick to react to it.
Just in terms of the other source of stimulus is obviously the government, and we've seen the medium-term budget policy statement by the finance minister, which had no surprises, but it was a little bit concerning. Is there scope for the government to stimulate the economy with fiscal policies at this point? And what effect will the downgrade have on the cost of borrowing for the government going forward?
Yeah, so the government are in a very tight spot at the moment fiscally. So they've done the right thing from post the global financial crisis. They've had to lean against the wind in counter-cyclically to try and prop up this economy. I think where the problems have come in is that they've been caught by surprise at just how much the private sector withdrew from investing and spending. And so, the more the private sector wasn't there, the more government had to step up to the plate. We're also in a politically sensitive environment with elections and midterm elections coming up. So, they've really pulled out all stops to do their part in terms of spending.
I disagree with you with respect, because that spending has really just been on the consumption side, employing more people in the civil service, but that investment infrastructure rollout that's supposed to be accelerated, very little evidence of that.
Look, that is true. The spending is completely imbalanced or unbalanced, if I can put it like that, and unless they address that, then there's serious implications down the line. So, the spending is not increasing the productive capacity of the economy as we stand, and that's going to be a major challenge for them down the line. So we've got deficits of 5% of GDP. So that essentially means the government is in an overdraft to the tune of 5% of GDP, and that's what has the rating agencies concerned. So that money needs to be borrowed in an environment where capital is still relatively available and relatively plentiful, but emerging market fundamentals and our own fundamentals are going in the wrong direction for attracting capital at the moment. So that's going to be a little bit more challenging going forward. The rating agencies are under pressure in this environment. They need to earn some credibility and to make up for lost ground from the global financial crisis. So they're going to be ahead of the curve in terms of, and this is what they're demonstrating now. They've sounded some warning shots over the bow, so they've downgraded us a notch, and they've kept us on negative outlook. So unless we see improvements in the government sort of fiscal side, we're likely to be under pressure from a credit rating side going forward, which will keep our borrowing costs elevated, and just, then you're in this vicious circle where you don't get out of this deficit because you're spending most of your revenue on servicing debt and paying down debt. So
Pravin Gordhan was acutely aware of that in Thursday's speech, and as we said here countless times on Thursday, he was speaking to the ratings agencies and trying to win them over to say we are doing the right thing. But what I find interesting is that in the run-up to his speech on Thursday, so the few days before that, our bond yields deteriorated, and presumably in anticipation of them wanting to increasing the deficit. But he made it very clear that they were not coming to the market and needing to borrow more, and yet there wasn't a correction. The market didn't relax after that.
I think both the bond market and the rating agencies, if I can speak for them, are probably tired of words and are looking for action. So we have these plans on paper for the last 5 fiscal years. The reforms that need to be implemented to put this economy on a higher growth path just don't seem to be taking place at the ground level. There are various sort of log jams along the way, and a lack of implementation is the biggest risk that we face. So on paper, plans are there, looks great, and there's sort of a thought process behind it, but implementation is lacking. So the market will not give them the benefit of the doubt, I don't think, anymore, unless we see evidence that they're going to be able to address the issues needed to take this economy to a higher growth path, and therefore put some credible improvements to budget deficits on the table. Because for now, it's kind of on paper and it's there, and I think it's very vulnerable to a slowdown in the economy. They're working with still fairly elevated growth numbers. If those growth numbers disappoint on the downside, they're likely to not be able to deliver on this fiscal improvement, and that's what the bond market's worried about.
And this has got knock-on effects for our parastatals. Do you think with some poor decisions, poor leadership, management decisions, it's affecting SANRAL, it's affecting Eskom too?
The rating agencies have raised this issue about sort of the quality and integrity of institutions, and that really talks to the policy uncertainty that is in charge of managing these institutions. So, in SANRAL's case, who's going to pay for this debt? Is it going to end up on government balance sheet? Is it going to be the users of the road that are going to pay the tolls? We've been through the whole Eskom one. Who's going to pay for the electricity? SAA, SABC. There's a whole lot of institutions that are in a state of flux as we wait for strong policy and strong leadership. And it's that, not so much the debt burden that the rating agencies highlight, but it's the policy uncertainty and the need for leadership to be firm and to put policy in place going forward that'll govern these issues that they seem to be a little bit more concerned about.
Conrad, just changing tack for a little while. We've seen the yields in some of the peripheral European countries coming down. We saw just a couple of months ago Spain at 7% on their 10-year bond. That's now come down to below 6%. Is Europe moving in the right direction at the moment, and do the yields reflect accurately the economic fundamentals there at this point?
So, I think there again, it's also a lot of talk at this stage. Admittedly, we've gone a couple of steps closer to some sort of implementation. The guys seem to be pulling in the same direction a lot more than they were, but still, it's talk. I mean, the ECB have basically, jawboned the yields down and kept them stable. There hasn't actually been a single buying of a peripheral bond in these various vehicles that have been set up. So for now, things are stable, but there's sort of a little bit of uncertainty about Spain, and are they going to go for a bailout, or are they not? There's uncertainty about whether Greece are going to get the next tranche of their sort of bailout money. There's uncertainty as to where the Germans are in terms of being pro-Europe or anti-Europe. So a lot of uncertainty there, Warren. So I think we'll see volatility in those spreads. The biggest issue is to get those spreads stable and even get them down, because these peripheral countries cannot afford to borrow and refinance existing debt at those spreads. It's just unsustainable. Many of them are borrowing and refinancing debt at 3 to 4 times what they did before the financial crisis, and you can only carry that for so long. Their economies are slow, the austerity policies are biting, and unless they're able to refinance the debt at attractive levels, they're just going to find themselves in a vicious circle.
Does this mean that in terms of the vehicles that they've put together that you referred to there, the EFSF and the other shorter-term mechanisms, is that not a sign that they're actually moving in the right direction now? So
those vehicles are there. That's the easy part, is to sort of establish the vehicle. The hard part is to tick all the legal and constitutional and political boxes to actually then go and use those vehicles. I mean, to give you a practical example, I mean, Spain would have been a large contributor to the money that would fund those vehicles. Spain is no longer in a position where they're able to contribute. So one of the large contributors that was going to stump up capital for the EFSF needs capital themselves. So, that just increases the burden on some of the other stronger guys. And there's pushback from some of the Scandinavian countries. Germany, as I've said, is still uncertain. So the whole thing is together, but it needs strong implementation, at this stage. Otherwise, the markets are just going to get tired again, and we'll just, have the bond vigilantes, who are the guys who tend to try to force policymakers' hands. They'll come back in again, push these spreads wider, and say, all right, there you go, enough talk, let's try again and see how serious you are about this, and then we'll take it from there again. So it's 2 steps sort of backwards after every 1 step forward at the moment.
Conrad, this is all new territory. So do you think this is all going to work, the ESM, the EFSF? And obviously this all is pretty significant for us, our ability to borrow abroad, our ability to maintain reasonable spreads.
Well, it's vital for us. So we are basically a small open economy, and we are at the whims of global policy, and we survive off this foreign capital that comes into our country. Very little in foreign direct investment, mostly in portfolio flows, buying our bonds and our equities. And these are your typical risk on, risk off cycles. So when risk is on and people are feeling comfortable with the world and the outlook for fundamentals, we'll get our fair share of the capital. When they're not, capital tends to leave and tends to flow out, and this is where we become vulnerable. The rand weakens, and then that's where we tend to run into some problems. So is it going to work? It's going to take some time, and the jury's still out. The problem is I don't know what the alternatives are. So if this doesn't work, I'm not sure where we stand.
It seems to be, it seems to be heading in the right direction. I kind of like to count the number of times that ECB breakup has been mentioned in the press to sort of gauge, what the sort of sentiment is at this point. And it seems to be lower, certainly after they've put that fund together, and the Germans sort of indicated through the Constitutional Court that they were signing up for it. That's kind of dropped down a little bit, but I still think it's quite a lot of cautions are required at this point, and obviously for fund managers investing overseas, I presume that most of these government bonds are still no-goes for investment managers.
Pretty much. I mean, the European peripheral bonds are really only bought by the banks that are already sort of so intertwined with the banking system and the sovereign system there that for them it's just, it's all or nothing. So, but investors putting money into those peripheral bonds, I think it's too risky, too soon still. There are better places to park your money from a capital protection point of view.
Conrad, thanks very much. That's Conrad Wood, the man who's head of fixed income at Momentum Asset Management.